Hello everyone, and welcome back to the channel where we demystify complex market concepts and shine a light on unique stock situations. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and potential short squeeze scenarios, focusing on a very specific name that recently hit our screeners, the Growhub Limited, trading under the ticker TGHL. Before we get into the details, a crucial word. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, let's talk about TGHL, the Growhub Limited. This is a company operating in the technology and software infrastructure sector, specifically focusing on product traceability, data analytics, and product trading facilitation in Singapore and internationally. With a current market cap of just $20.04 million, TGHL is firmly in the microcap territory. Looking at recent price action, it's been a bit of a mixed bag. Today, TGHL is down 10.44%, which might seem concerning. However, zoom out a bit, and we see the stock is still up 9.51% over the last 5 days, and a staggering 79.91% over the last 30 days. Chart TGHL 30-day chart. Clearly, there's been significant interest and volatility. What is cost to borrow and why it matters? Now, let's tackle a fundamental concept for today's discussion, cost to borrow, or CTB. When an investor wants to short a stock, they first need to borrow shares from a broker. Just like borrowing anything else, there's a fee involved. This is the cost to borrow. It's an annualized interest rate that short sellers pay on the value of the shares they've borrowed. A low CTB might be 0.25% or 1%. But where a stock is in high demand to short, or shares are scarce, that fee can skyrocket, often well over 100% annually. Imagine paying 100% of the value of the shares you borrowed every year just to hold your short position. That's a huge cost that eats into any potential profits. This is why CTB is such a critical indicator when assessing the pressure on short sellers. Why the stock is hard to borrow right now. This brings us directly back to TGHL. The Growhub Limited appeared on our hard-to-borrow screener for one undeniable reason: its annualized cost to borrow fee is an astounding 773.1%. Highlight 773.1%. Yes, you heard that right, 773.1%. That is an extremely high fee, indicating that shares of TGHL are incredibly difficult and expensive to borrow for short sellers right now. While the exact number of shares currently available to borrow is unknown, a fee this high speaks volumes about the scarcity. With an estimated float of just 12.7 million shares, if a significant portion of those are already shorted or tightly held, it creates a very constrained supply. Our internal composite squeeze score for TGHL, which combines factors like CTB, borrow supply, float size, and momentum, currently sits at 46.5 out of 100. This score suggests it's certainly on our radar for hard-to-borrow potential, though not yet at the very top tier of squeeze candidates. Squeeze mechanics explain. So, what does it mean when a stock like TGHL has such a high CTB, and how does that tie into a short squeeze? A short squeeze happens when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to limit their losses. Think about those short sellers on TGHL who are paying 773.1% to hold their position. Every day the price goes up, their losses increase, and that massive borrowing fee keeps piling up. If the stock price continues to climb, these short sellers can be squeezed. They are essentially forced to abandon their bearish bet by buying shares in the open market, which creates even more buying pressure, pushing the price even higher, and so on. It's a self-reinforcing upward spiral driven by short covering. This shrinking supply of borrowable shares, combined with an increasing cost to hold, can create a powder keg. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction that the stock is overpriced, and they are willing to pay those exorbitant fees to maintain their bearish position. Dilution risk check. One critical factor that can make or break a short squeeze thesis is dilution. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This influx of new shares can provide liquidity for short sellers to cover their positions more easily, and it reduces the earnings per share for existing shareholders, often depressing the stock price. Our checks for TGHL found no recent dilutive SEC filings such as -1s, -3s, or 424 BS in the last 90 days. This means, at least for now, there isn't an immediate threat of the company issuing new shares that could flood the market and potentially negate any squeeze potential, which is a positive data point for squeeze thesis. Again, let me reiterate this important information. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For TGHL, given its unique profile, here's what to watch. The extreme 773.1% CTB is the headline. Keep an eye on the bar desk data if you have access to it, looking for any changes in shares available to borrow. The company's small estimated float of 12.7 million shares means any significant buying or selling volume can have a pronounced impact on price. Today's volume for TGHL was only 288,300 shares, which is dramatically below its 30-day average volume of over 10 million shares. This translates to a relative volume of 0x average today. Show volume BAR chart: low volume on a down day after a strong run could simply be a breather, or it could signal waning interest. We also saw a massive 79.91% gain over the last 30 days, so monitoring whether that momentum can reignite after today's dip will be key. Any sudden influx of buying volume could put immense pressure on short sellers already paying such high fees. In summary, the Grow Hub Limited TGHL presents a fascinating case study in the hard-to-borrow stock universe. Its incredibly high 773.1% cost to borrow fee immediately flags it as a stock where short sellers are facing extreme pressure to maintain their positions. Combine that with a relatively small float and no immediate dilution risk, and you have a situation worth understanding. While today's price action was negative, the longer-term momentum is clear. Keep an eye on TGHL, not as an investment recommendation, but as a live example of the dynamics we discuss on this channel. If you found this deep dive into TGHL informative, please hit that like button, subscribe for more content like this, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.